liquidity providers have assessed the physically driven gold rally has simply paused mid-rally, which is what we said last time. That's all that had happened. It paused mid-rally with fresh 2026 targets being reassessed as high as $8,000. Liquidity providers estimate silver will regain and blow through its all-time highs, which were here in October, well before the end of the year. And in fact, we're looking at potentially a lot quicker. On aggregate, first quarter of 2026 estimates a minimum of $80, and it seems like a stretch.
Market veteran Andrew Maguire highlights how institutional investors are interpreting the current landscape of precious metals. Equity providers view the recent pullback in gold not as a reversal, but as a brief pause within a larger, physically driven rally, one that now carries upward revised 2026 targets reaching as high as $8,000. At the same time, liquidity providers are signaling a far more aggressive trajectory for silver. Their models suggest that silver not only reclaim its previous all-time highs, but also surge through them far sooner than expected. Many project these levels returning before year-end, with first quarter 2026 estimates clustering around a conservative minimum of $80. What once appeared ambitious is now being treated as a realistic outcome of tightening physical supply and accelerating global demand. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I think what we'd said then was, hey, this was helpful. Not only has it taken out the speculator element of that October rally that hit into all-time highs, we call them pestilences because essentially these guys are just going to make it more volatile. But into the process of shaking out these hot money speculators, we've just witnessed, and this is the important part, we have just witnessed the largest ever transfer of gold and silver wealth from weak hands into strong at a substantially higher physically supported rally stair-step. So while the 10% top to bottom correction has cleaned out all the froth and has now wrong-footed these same leveraged actors to flip from naked long to naked short, bless them, selling gold and silver into very strong physically held hands is what they've ended up doing. And it also did not go unnoticed that the trigger point to target these ballooning speculator positions was timed with Trump's tariff, China posturing. Wasn't it just tariffs? We were arguing about rare earths, sanctions, and one thing and another. And as we will look at shortly, in retrospect, the very short-lived Trump BRICS tantrum backfired, re-energizing the next de-dollarizing leg. So let's start by reviewing the short-term footprints and really to identify where the largest institutional size spot gold and silver buyers are taking the long side of these naked short momentum traders who are still in there, and how this translates into where these physical orders are aggregating right now. Actually, from a paper to physical perspective, it's pretty straightforward, really. But let's start with silver. So in silver, the very strong SGEI, the international facing SGE exchange, the physically determined support that we reported last time was at spot 48 bucks, and this was around here, and it indicated synthetically driven dips below this physical support level were nothing but an opportunity to convert underpriced synthetic silver into bullion. Bear in mind, we'd just been through a 10% correction at around about the pit open, because at the pit open we do tend to get selling events coming in. But I think they're getting run over, and we wouldn't count them completely out yet, but it's getting very close to a breakout. Now, because silver has been backwardated significantly, I mean, we talked about $3 spreads at one point, that is $10,000 per contract. Apologies, $15,000 per contract differences. And we'll look at how that is settling down and really what that means. But essentially, because there was a difference where we show, this is the futures chart, so where we show 47.90 was in fact the 48 spot level. So we had to make those adjustments on the futures charts. Now, if you're a soulless futures trader, you're not going to be aware of the fact that spot silver was already above 48. And this is where institutional, strong very strong institutional buying was occurring. Now, this window of opportunity to buy physical silver at or below $50, and $50 is $49.90 in futures. So any opportunity to buy silver below that price is very, very short-lived if there are any more pullbacks. And back over to the spot chart here, which is reflecting the real price. Essentially, with specs flushed into very tight supply, liquidity providers estimate silver will regain and blow through its all-time highs, which were here in October, well before the end of the year. And in fact, we're looking at potentially a lot quicker. On aggregate, first quarter of 2026 estimates a minimum of $80. And it seems like a stretch, much like when we looked at the beginning of the year and we're talking about the 50s being overtaken very quickly. This is coiling to happen. In fact, it's more likely $140 per ounce before enough offers to sell to meet demand. So to take advantage of these physically underpriced global fixes, Beijing has systematically sold dollar strength against foreign exchange gold to de-dollarize at an optimum level without even notably affecting the dollar price. Now, over time, it's had an effect. It flies under the radar on intraday. Now, even the bullion banks are doing it. What they're seeing is that the dollar used to be correlated 1-to-1 with gold inversely. So you've still got the automated guys that see the dollar rise, they come in and automatically sell. Not so. The bullion banks and their clients are saying dollar strength equals sell dollar to buy gold. This is a huge disconnect, not realized by so many. And again, clueless mainstream media. So this over-the-counter foreign exchange management serves really two PBOC objectives, really, mandates, really. So it smooths out the citizens' CNY facing price, maintaining Beijing's citizen gold price appreciation promise. But that process has also enabled the PBOC to drain Western gold to the tune of some 80,000 physical tons. We've talked about this before. There is tons of evidence to suggest that that is the real number. And that's why they're taking their gloves off. They don't have to hide anything anymore. A rising gold price enables Beijing to challenge Trump and the dollar. And it's a primary reason gold's share of global reserves on a balance sheet has significantly surpassed US treasuries. And even though that's reported by the World Gold Council, it's significantly higher than they report because of monetary gold purchases. So as we enter this next 2 weeks action, we see nothing but stack-up opportunities to exchange your depreciating dollars, your pounds, your euros, etc., for real money assets. Gold and silver is what we're looking at. And while we see the opportunity, there's a complete opposite in place where officials are still fighting a rising gold price. Keep it up, guys, because we're taking it. The increasingly liquid SGEI, physical gold corridor, is stealthily onboarding real money, high quality liquid asset gold assets, also coattailing exactly what the PBOC is guaranteeing its citizen, a rising gold price. The moment the yuan became 1-to-1 physically backed, this correlation was absolutely assured. Now, the desperate attempt to chart paint, and we've seen it, kind of blew off on Monday. The desperate attempt to chart paint a lower weekly gold and silver close just backfired into waiting physical buyers. So basically, circling back to very, very, very short term, gold and silver are rapidly moving into strong hands with very large short stops laid above the market and naked long momentum specs rinsed and commercials 1-to-1 taking the long side of these freshly retrenched naked shorts. Liquidity providers have assessed the physically driven gold rally has simply paused mid-rally, which is what we said last time. That's all that had happened. It paused mid-rally with fresh 2026 targets being reassessed as high as $8,000
Andrew Maguire explains how the recent correction in precious metals triggered one of the most significant wealth transfers from weak hands to strong hands in modern market history. The pullback removed speculative froth, flipped leveraged traders into vulnerable short positions, and delivered physical metal into deep, committed demand at higher structural levels. He emphasizes how geopolitical pressure, particularly tariff posturing and U.S.-China tension, accelerated this transition, reinforcing the broader de-dollarization trend already underway. Physical markets, primarily through the SGEI, continue to reveal firm support zones where institutional buyers consistently absorb synthetic dips. With backwardation tightening and global fixes increasingly underpriced relative to physical demand, gold and silver are steadily migrating into stronger hands as commercial players accumulate in every forced sell-off. Let's get into the interview.
Now, China has gained full control of the physically settled global gold price setting mechanism, and is far better able to serve the needs of producers, institutional investors, financiers, hedgers, who are attracted to being able to operate in an audibly smoothed out, stable, physically settled, high quality liquid asset supply demand environment. Now, by design, direct one-to-one convertibility of the yuan to gold and reverse is attracting these global central banks, sovereigns, and Western-facing institutional investors. Think about it. You're talking about finances. You're talking about the huge hedging business that used to belong to the cartel. And now they're able to buy and store and utilize this high-quality liquid asset physical gold within a smoothed out, physically determined supply-demand price settlement condition. And as we previously assessed, gold is collateralizing offshore facing repo markets. It's not just realized that by any of the mainstream media analysts on Bloomberg, a big chunk of the day, not a single mainstream media analyst, and they just don't get that the ability for central bank sovereigns and all categories of Western-facing global investors and these hedgers and producers to be able to treat gold as a high-quality liquid asset on their balance sheet is driving the next unfactored wave of gold demand sufficient to discover a gold price that easily doubles current estimates. So looking at the option structure for December futures expiring on the 24th of November. That is really the biggest contract of the year expiring. In fact, it's the only contract where gold and silver futures expire on the same day. That's the 24th of November. And then it moves on to January, February, March contracts. But essentially, this is a big delivery month. So there's been a lot of gaming to try and get the capping in place. Now, however, if you look at the structure, there's really very little need for the cartel to close silver below $48. And that was the previous resistance, which has now become massive support. In fact, one spot, 52, gets taken out. In fact, I'm just looking now and I can see that spot is at 52.5 already, just spiked up. Now, obviously, the recording that I did just a little while earlier didn't even catch that. So really, basically, big time. It is actually, now that we've seen 52 taken out, liquidity providers had already identified very large short stops all the way into 55, like we said in the recording, just the recording I made a little while ago. Drilling down into what we'd observed in our last episode, while the LPMCL, the cartel, had been able to paper over the worst of its real physical silver shortages, assisting in somewhat narrowing this deeply backwardated futures to spot basis spreads. If you remember, we talked about there was the spot was trading at $3 higher than futures, $15,000 per contract above. They're still in backwardation today. This should not be occurring so close to the largest options expiry of the year on the 24th of November. And it illustrates there is still a massive lack of paper supply to meet international facing demand, where paper supply has to be turned into physical. And while these same four LPMCL actors, the cartel, also have a footprint in the COMEX, and they do have a footprint in the SGEI, the international facing Shanghai Gold Exchange hub, and they've raced to ship silver back into London to avert what was definitely a full default. As soon as this bullion lands, it's just drained immediately. That's why we've got backwardations. And as we have identified before, liquidity providers were reporting in capitals, very strong SGE demand into mainland export controls. And while the SGEI silver was shipped out by the LPMCL to capitalize on interim local London shortages scrambling, these shortages still exist. But so as to not drive the silver prices higher while they scramble to buy back these ETF shorts way before China and the US officially announced silver was being added to export controls, these restrictions were already quietly being applied by stealth.
What becomes evident from this analysis is that the center of gravity in the global gold and silver markets has shifted decisively toward physical settlement, with China now playing a pivotal role in determining accurate supply-demand pricing. The transition to a one-to-one convertibility framework has opened the door for sovereigns, institutions, hedgers, and major producers to treat physical gold as a high-quality liquid asset, driving a powerful, yet still underestimated wave of structural demand. Silver's persistent backwardation, rapid vault drainage, and aggressive SGEI buying continue to expose the fragility of Western paper markets, forcing bullion back into tight physical channels even as the cartel attempts to suppress visible signals. Each dip accelerates the migration of metal into strong hands, tightening the system further ahead of major delivery windows. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.